Hi, good afternoon. This is Sean Rosenthal with CBRE. Thank you for joining another AmTrust title webinar series on lending in today's market, sponsored by my good friend Steve Napolitano, Senior Executive VP of AmTrust Title. Really happy to be here with such distinguished panelists to talk about the current market. Let's start by having each of the panelists introduce themselves and who they are, who they work for, and then we can start to get into it. Why don't we start with Joe Fingerman?
Hello, everyone. Thanks for having me. I'm Joe Fingerman. I run the commercial real estate group at Signature Bank. We are a New York-based commercial bank, approximately $52 billion in assets, with about $26 to $27 billion in New York City multifamily, retail, and office loans. So thank you for having me, and we look forward to a positive panel.
Thank you. Why don't we go now to Joe Dykman?
Hi, thank you again for having me, Sean. Joe Dykman. I co-head the U.S. Commercial Real Estate Finance business for Citi. I've been at Citi now for approximately 10 years. Started my career at Bear Stearns, also in the CMBS business in 1998. So have been, working in this business for quite some time, and looking forward to speaking on the panel today.
Joe, and you focus on what types of loans?
So we have three programs. I can get into it now, but we have.
Wait, hold. We'll get into it later. Bill.
Sure.
Hi, my name is Bill Weber. I'm an originator at Newmark Knight Frank. My focus is on the multifamily capital market side. As a firm last year, we did approximately $37 billion of multifamily capital markets transactions, with roughly $22 million of that on the sales side, and a little over $15 million on the debt side. For my team, we did approximately $3 billion since we moved over about 18 months ago.
And okay, let's get started. Oh, Tony. Go ahead, Tony.
I'm with Acor Capital. We're a non-bank lender, primarily in the bridge space. We have a fixed rate program as well. 17 or 18 billion dollars of assets under management, mostly whole loan execution, and we did about $7 billion last year. And I oversee the East Coast.
Great. Okay, guys, so thanks again for everyone. We tried to have a different perspective here, a bank, a kind of transitional lender, a CMBS shop, and then a multifamily lender, Fannie Freddie. So everyone is obviously concerned with liquidity, starting with the pandemic in March. Things have been moving in all over the place. Some people are lending, some people are not. We want to talk about who's doing what right now as we sit here on June 4th. And so what I wanted to start with was what I think is the hottest sector right now and the best place to go get loans, and that's the multifamily sector. And so, Bill Weber, why don't you talk to us a little bit? I was on a panel this week with 3 investment sales brokers from CBRE around the country: Boston, Washington, and Phoenix. And many of them were talking about how those markets are starting to pick up significantly. They're starting to come to market with projects where they were kind of halting new investment sales deals and are starting again. Why is that? I think it's because of the debt, but talk a little bit about Fannie and Freddie and what's going on in those markets.
Sure. I think multifamily generally is probably the most liquid market of any asset class. A big part of that is Fannie and Freddie are half of the multifamily lending today. If you look at rates, they're at historic lows. You can do lower leverage deals at sub 3% coupons. You're seeing fuller leverage deals in the low 3%. And because there was a pause with COVID, if you look at where Fannie and Freddie are relative to their budgets, there's a lot of dry powder left. So debt like that will drive sales. If you look back 2 months ago, things kind of, there was a shock in the capital markets. So generally, people were doing refis. Stuff that was on the market for sale got put on hold. So about 2 months ago, we saw about 90% refi versus 10% acquisition. In the past month, that went like 80-20. And now there's a lot of green shoots, as you alluded to, with people in your firm, of deals coming back to market. So I think over the next, through the summer, you're going to see that shift going back to kind of historical norms of, closer to 50-50.
Got it. And what we're seeing is a lot more floating rate business. Are you seeing that? More floating rate loans versus fixed rate loans, or is that not what you're seeing?
I am. It's somewhat counterintuitive. When you can see fixed rate loans below 3%, you would think that people would kind of jump in to lock in long term. But there are a number of borrowers who want flexibility. Part of that is people are putting their decisions of whether or not to sell on hold. So they're going with shorter term floaters, which again are about the same rates as the fixed rate. And then kind of deciding over the next 6 to 12 months what they want to do with their portfolio.
Right, and I just want to add a few things very specifically because I'm seeing the same thing. I mean, we're on the market in terms of like real live transactions, portfolio in Long Island, just let's say approximately 65% leverage. When you do the math, you're at a 135 cover, and before rates went up 10, 15 basis points, we were seeing 10-year fixed rate IO deals at 2.75% interest, which if you can borrow like that, it's insane. But Bill, talk about, though, before we move on, talk about any of the changes in terms of new reserves due to COVID and what you're seeing with those reserves, where they were, where they're going. We're starting to see those loosen a little bit, but maybe you can touch on that too.
Sure. I would say as far as the underwriting criteria itself goes, it's not that dissimilar kind of pre-COVID, post-COVID as far as an underwriting goes. There is a little more scrutiny on recent collections. Certain markets, if it's tied to energy or tourism, will get a little bit more scrutiny. But the basic underwriting is still generally the same. They have introduced debt service reserves, which are kind of tiered based on your leverage. So fuller leverage deals are going to get longer, or commensurately longer reserves. As you go to lower leverage, they scale back to, at low enough leverage, they'll go away completely. And those reserves can be, once you hit your test based on whether it's Fannie or Freddie, you can get those back starting within 3 months to a year.
Got it. Great.
And then that has changed over the past month.
Is that a
Almost
static reserve?
Yes, it's basically evolved over the past month. There was a lot of concern over what's going to happen with collections. And I don't want to say collections have been a non-event, but they've done much better than people were anticipating. Certainly, if you look at multifamily versus other asset classes of tenants paying rent, it's in the percentage basis in the 90s, where industrial and offices in the 80s, and I mean retail is really lagging. It's probably half of that.
And do you guys anticipate? I'm sorry, I'm jumping in here, but do you anticipate?
I'm surprised it took so long.
I'm sorry.
8 minutes, Sean. That's good.
Do you anticipate when you're underwriting? Are you anticipating rent collection will continue to be at the pace it's been the first couple months of all of this situation we're in, or are you underwriting for a fall off based on maybe less stimulus, less as things settle in? I know we're talking about reserves, but I'm asking you whether the way you underwrite this, are you looking at are you underwriting a decline in collections? Sorry, Sean.
That's
really
good.
curious.
The answer is yes and no. So we're looking at both, a T12, a T3. We're paying particular attention to the trends over the past couple of months. You're also looking at what's happening over time with, factoring in various scenarios for your exit test, what could happen with rates. But I'm not going to forecast what will happen. It does feel pretty good so far. Certainly vis-a-vis expectations where collections have come in, it's far exceeding every other asset class. So you're not going to see the same level of speculation that you're going to see on other property types and what can happen to the cash flows. I think they're on stabilized properties, certainly less variable than you'll see elsewhere.
And Tony, what we're seeing is if the variance is less than 10%, let's say, in collections, you generally have some rope with the agencies. It's not exactly like, to the T, but that's why they have these interest rate reserves for some of the uncertainty surrounding collections and COVID impacts of collections. So if it's a major drop, I think, in the last month or so, I think then you'll have an issue. But if you have a 5 to 10% drop, I think that's kind of what the reserve is set up for. I want to move on to Joe Fingerman. Joe, you're an active bank lender. You're holding in that smile. Talk to us about the bank market. What are you actually lending on today? I don't want to know about 3 months ago before COVID? Like, what are you lending on today? What does the deal look like? What's the rate? How do you underwrite? Give us a little bit of background on what you're actually able to get done today.
Tony, do you have any questions also? Or I can include them all together. No.
I might.
So Signature obviously is very deposit and customer focused. So for our existing clients, we are continuing to lend during the COVID, situation. We generally are trying to limit cash outs. We don't have exact parameters, but if you had a $15 million loan, it's probably not going to 25 million, but it could go to 16, 17, some area like that. We are requiring reserves because of collection issues for either 3 or 6 months. It's pretty much principal and interest, or if it's just in certain scenarios, it could be reserves tied to income. We're not letting them use the reserves. It's somewhat static. Of course, everything at Signature is negotiated, so there's all different variables depending on who the relationship is or what the situation is. We're lending 5 and 7 years on our balance sheet. We have for certain clients and loans that we want to keep and that I don't want to lose to, I guess, Joe, or the Fannie Freddie products, we do have some swap transactions that we've begun doing just to maintain those good loans on our books. Right now, we are busy also with forbearances. We have a portion of our portfolio that cannot pay principal or can't pay principal and interest, and we're working with those clients, to work through that as we speak. Volume is down. It's mostly refinances. Primarily, I think the sales market's very slow in New York. We only lend within 50 miles of the New York metro area, so I'm not as national as Tony and Joe are. So this area is not, just not there yet. I thought we were turning the corner maybe last week. The recent civil unrest is making, a little bit of a pause for people wanting to transact. And we're going to see what happens. But if you're a client of ours, or we like the deal, we're also looking at this opportunity right now. Some of our competitors at times can't get out of their own way, so we're seeing if there are good deals. Let's figure out how to get it done and put it on our balance sheet. We got some of our best deals when the group started between 2008, 2009, as other lenders contracted in the marketplace. So we don't want to lose focus on that and see what we can get as far as 50% loan to values that other lenders need reserves up the wazoo for. We can see if we can be more creative.
So Joe, you want the Fingerman, you want the good deals. I just want to write that down so we can only send you the good deals.
Just don't send me any deals then.
But you didn't say, is it multifamily only? Like, are you lending 60%? I want to get specific.
Okay, you want me to give you
is
all
the rate 3?
secret sauce?
Is the rate 3.5? Is the rate 4? Is it recourse? Is it non-recourse? Tell us what you're doing.
Multifamily is generally lending at 70 to 75%. It's in the the mid 3s for 5-year money, slightly higher for 7-year money. We're lending in the multifamily space. I think retail right now, unless you're a significant client or you have significant credit type tenants that we're comfortable with that. We issued a term sheet recently on a Target, which was last week before the other unrest, but we're looking for very strong tenants. A restaurant tenant, I'm not sure today that we would be lending on it just because of the unknown. Those are closer to 65% and they're closer to the 4% range. Office, again, interested in office, it just depends on what basis we're at. 65%, 130 or higher amortizing debt service coverage, we're there. Industrial is very hot. We're seeing a lot of industrial deals, and we are lending in the 65-70% range there. Was I specific enough, or do you have further?
That was great. Is there any interest-only components, or is it just amortizing?
Interest only depends on leverage points. It could be up, if it's under 50%, it could be full term. It just depends on where, we value the property and we feel comfortable. Then we have the appraisal confirm it.
Got it. Awesome. Thank you for answering my very specific questions. Tony, I'm going to make you wait. Joe Dykman, CMBS market, everyone said was dead 2.5 months ago. And I know when they started saying that, you completely shaved your head. Since then, what's going on at CMBS? We've heard and seen certain transactions get done. Talk to us about what's going on. Are you quoting loans? What, if yes, what those loans need to look like to be of interest?
Sure.
And what's happening?
Yeah, so before I get to that, I just want to say that at Citi, we don't only lend in the CMBS market. We do have 3 programs. CMBS obviously being our primary program, but we do have a very active balance sheet program where we're actually signing up a bunch of business right now, cash flowing assets that need a bridge to either a longer term fixed rate or a bridge to sale, sort of $40 million and up. And we've had a lot of good traction there as people sort of wait to see what happens in the long term fixed rate market. And then we also have a warehouse note financing business where we finance companies, and also some note on note financing, which is getting more active, and we can delve into that later as well. But with respect to CMBS, yeah, so just a quick history of where we were. AAA's pre-COVID 80 over approximately. I think we peaked at 76 in January. In the secondary markets mid-COVID, we were trading as high as the low 300s. The last few deals have gone off in the sort of 140, 145 range. So, you know, there's clearly demand. Pricing has come in a lot from the wides. There's been 4 deals that have priced, plus also the bottom of what we're calling Viva, which is the MGM and Mandalay, which priced also recently. So there's been 5 or 6, maybe because City Plaza LA office deal that was done in California. So about 6 deals that have priced since COVID began. You know, we're starting to quote.
That was all product that was originated pre-COVID, correct? Like that was warehouse loans.
Legacy product that was, you know, originated pre-COVID.
Okay.
We are now starting to originate and sign up new business for new origination. Similar to what Joe Fingerman was saying, you know, the asset classes are, you know, industrial, you know, self-storage, office that have good collections, and, you know, clearly deals that, you know, are COVID proof in terms of retail, you know, Target, you know, we're looking at a big Target portfolio, Amazon distribution center, clearly the hottest sort of, you know, sector as you just stated. 65 to 70% leverage, all in pricing is anywhere between 3.5, you know, to sort of 4.5% right now, depending on the leverage. The CMBS model is a very debt yield and cash flow driven pricing model. So the higher the debt yield, the lower the pricing is going to be. So we're starting to aggregate new business for future pools that we expect to go off hopefully, you know, sometime over the next 30 to 60 days.
Got it. So a 65% office building acquisition or refinancing with good tenants, I mean, tenants who are paying rent, collecting, that would be at around what kind of price? You know, assuming a 9 plus day yield.
4%. That's basically, you know, in the low 300s type of spread. You know, the 10-year is actually quietly creeping up. I think we're at 80 basis points right now on the 10-year. So, you know,
last 2 days is up 12.
Yeah. No, there's a big risk on right now. I mean, we've seen high yield and IG, you know, come in. And so we think we're hoping there's going to be a rotation into CMBS for investors as well. You know, that remains to be seen. I think, you know, the commercial real estate market is clearly a lagging sort of market right now, given the fundamentals. But we do have, are requiring, I should say, you know, interest reserves depending on the deal and the leverage, similar to what Joe Fingerman was speaking about earlier.
So someone puts up a certain amount of months of debt service in a reserve, and does that get released? When does that get released? Does that get used? Like, what's the concept there?
So these are not, generally speaking, not static reserves. They can be used, and they have to be replenished until you hit a certain debt yield or certain collections, or if it doesn't get used for a certain period of time. It just really depends on each particular deal and the leverage and the sponsor.
Got it. Before we just move on, just a few more things. You started to mention the single asset, the SASB market, single asset, single borrower. Talk about, are there new originations happening in that market? I know there's some trades that happened already, you know, on legacy assets, but are there any new deals getting priced kind of in the large loan, single asset deals?
Yeah. We're starting to see some large portfolios, some large industrial distribution, sort of last mile type of assets There's a bunch of those sorts of assets for sale that I think would be received well within the capital markets SASB space. So we are starting to see that. But I think it's very sponsor specific. And I think that, unfortunately, New York City is going to lag in that respect, just given how bad we got hit from COVID and sort of other events. So we'll see what happens there. But I think we are starting to see some SASB deals outside of the New York City metro area that we are starting to price.
And then one last question. You mentioned your balance sheet. Talk about the types of deals. Like, what do those look like? What you said, 40 million and more. What kind of leverage? What kind of terms? Like, what fits for that bucket also?
Yeah. I mean, I can't mention any specific deal names, but I could just
No, but the flavor.
One particular deal a couple of deals that come to mind are, a single tenant out west acquisition loan that historically would have gone for a 10-year fixed rate sort of financing. The buyer believes that CMBS spreads will compress as, COVID sort of that impact goes away. And so that's a 2-year bridge loan, 65% leverage in the context of like L325 and a point. So we are seeing a few of those sorts of assets, cash flowing deals for the most part, in that sort of 60-65% range.
Great. Thanks very much.
300s to high 300s, depending on the leverage and the debt yield.
Great. Thanks. Tony, it's you and me for the next half hour, so we'll be good. Debt funds are dead also, right? CMBS was dead. Debt funds are dead. Your transitional lending, or maybe the rates just went from L plus 250 to L plus 750. Is that true? What are you doing? What are you bidding on? Anything? Give us some real live knowledge of what's happening.
Well, I would say that some debt funds are dead. We are hopefully not dead that I'm aware of at this point. Maybe I'll find out after this call that I'm dead.
Hold on, you have an email? If you...
I think I hear some Australian accent in the background.
It's interesting listening to it seems like what I'm hearing from you guys, or most of you guys, and it's the beginning of the thawing out of the market, But so you asked about what we're doing, and I talk to a lot of guys that are in the same space that we are in. So I think this is generally the case. There is nothing programmatic about what we are willing to invest in today. And I know you're going to push me to try to get to tell me that it's LIBOR X and what the structure looks like, but there really isn't. We have a gigantic portfolio of loans that we manage on behalf of our investors, and we are spending 90% of our time dealing with that, right? And frankly, preserving capital to deal with providing liquidity potentially to borrowers on the assets we have on our balance sheets, and just defensively addressing those kinds of needs. A lot, we at least the guys in our world, we've become where we weren't before. We've become significant asset managers at this point. We had a dozen and a half deals that we had signed up when this happened, and we closed them. Some changed a little bit, but we closed those deals. We probably have 1 or 2 that are left. And as far as what we're looking to do from a new investment standpoint, the truth is I don't actually know. It's more like I will know it when I see it. We're not interested in chasing deals. We're not interested in if the market's at LIBOR 325 for something in a point, we're probably not there, right? We're interested in, I guess we still believe that we don't have the at the moment the need or the desire to just pour money out for anything that comes along. So we're not, like I said, we're not chasing anything. And I think there's still some discovery in our mind to figure out, at least at the basis that we usually lend, or at the leverage points that we lend, or the product that we lend at. So we lend on cash flowing deals, but we are more of a bridge lender. We also, the truth be told, we have a quarter of the portfolio is probably somewhere in the neighborhood. A quarter of the portfolio is hotels, right? So we're working through that. I'm not sure we want to put a lot more of that on the books. I would say we've discussed internally where we want to lend, and I would, this is a generic answer, and I think it's kind of what everybody else is saying, but it's mostly in multifamily or industrial space. but it's probably, you know, it's wide of where we were before. I don't think it's 250 to 750 as you described before, but I think it's, you know, it's 150, 200 wide of where our brethren were before.
There's no question. I think that pricing is 150 to 250 wider. I think you know what everyone talks about is a lack of their A-note financing. Every debt fund has, you know, a line or finances themselves through a CLO. How are you seeing that part of the market?
So that's actually a good point. One thing before I said it though, the other thing that I think is happening, and you know, we see a fair amount of deal flow, and we're still seeing a fair amount of deal flow, but there's a lot less deal flow from the likes of CBRE and not to mention your competitors, but Meridian and Eaststill and JLL. There is less product as far as I'm concerned in our space than there was before. We're still seeing deal flow, but I mean, part of what you're asking for, you know, we're starting to the thaw, I think, is starting to happen to a certain extent, but there's just not a lot of product to go around. There's not a lot of people that want to. I think this is we're in the you have to finance market, not in the you want to finance market today.
That's fair. That's fair.
In terms of so obviously a lot of the guys in our space are financed and require financing to execute transactions. Most of our portfolio is actually not leveraged because we lend for separate accounts, and so we don't have a lot of leverage. So we're not dealing with financing pressures that a lot of our competitors might be dealing with. Unless something's changed very recently, there is not it's an understatement to say there's not a significant A-note market and there's not a significant repo financing market today, warehouse market today. So I mean, I don't know, Joe, you guys have a repo business, correct? I mean, I don't know, it's not easy to put new assets onto warehouse lines today. It's not easy to, because I think that the repo lenders are looking at the same thing we are. They're working through these deals. I think when this first started, I think there was an assumption that the repo lenders were going to crush a lot of guys like us. They were going to but interestingly enough, I think the repo lenders actually stood back and said, you know, we don't really want all those assets either to deal with, right? And so I would say there's been a lot of cooperation with the warehouse lines for a lot of us. There's been negotiation, there's been back and forth, but the market is not very frothy now for A-notes and repo, and so it's going to be it's going to take that for the non-bank world to really come back in you know, in a big way, I think. But like I said, we have balance sheet. We lend on behalf of a couple balance sheets that we have separate accounts, and we have the ability to put money out that is a whole loan execution, but we're not seeing, you know, what we think is the right risk-adjusted return right now. So,
Joe Dykman, is that true? Like, how are you handling? Do you have repo facilities out to, you know, the likes of Tony? I will. We're going back to you. We're going back to you. Don't worry.
No, I'm just going to say to Tony, and again, we can't get into obviously certain situations, but we've tried to have a very constructive dialogue with all of our counterparties. Right. But it clearly is, you know, more difficult to extend credit when there is greater uncertainty. Having said that, we are still extending credit and we are still financing. I think that, like you said earlier, in that space, it's sort of a have-to type of finance market than right. more of an elective type of finance market. And, you know, as things thaw, that will probably change, is my, you know.
Well, I also think that most of the guys that are in your space and in that warehouse repo space are, I'll say, allegedly extending credit, and there are deals getting done. I mean, there's no broad brush you can paint to any of it, but you're also, I mean, on the one hand, you're going to put out credit, you know, to somebody that you have a line with when you're dealing with 6 other loans that you're kind of working through and figuring out whether or not there's a margin call, whether, you know, it's just a way more tepid market than it is in the normal sense. That's all. So it obviously reduces financing.
I mean, it seems to me that people, you know, Tony, you lend on business plan types of deals, and it's hard to forecast who's going to be there, what the rents are going to be, what the demand is going to be.
That's why,
So not surprising you're having a hard time finding, and your A-note lenders are gone. Like, it's not surprising that you're finding a hard time, with new deals at this point.
yeah, I mean, I feel like the bid ask is still significant, at least the way where we look, where we're interested in investing. But that's why I asked the question before about, when I interrupted you and I asked the question about how people are looking at things from a forward basis, because clearly the multifamily, the renters paid rent when a lot of people were predicting they wouldn't, right? I mean, that happened. A lot of multifamily renters paid rent when people predicted they wouldn't, but there was also a time, there's a ton of money that poured into that was printed and handed to renters to pay rent. So we are sitting here, and I think our repo lenders are doing the same thing, are looking and saying, what does, it's a little bit hard to predict the future. And like you said, we typically are a business plan lender. So
I just want to quickly touch on, a few of you mentioned this just in your speaking, but what's going on with some of the stuff on the balance sheet? Tony, you have a lot of hotels, obviously working through modifications. Joe Fingerman, you mentioned some modifications you're working on. Talk to me about like the tenor of those conversations, what you're doing. Bill, I know Fannie and Freddie have offered modifications, but I know Freddie, only 2% of the loans out there have taken them, and Fannie, I think 1%. So it seems like everyone was really nervous about this 2.5 months ago on the multi side. That's not, as we said, it turned into an issue. But Joe or Tony, talk about some of the modifications or some of that, what's going on in that space.
you go first, Joe.
Okay. On the modifications, on the first, we're giving up to 6 months. We're doing them in 90-day increments. The first 90 days is sort of like you call, and if it looks like it makes business sense on paper, we're either forbearing principal or in some cases principal and interest. A lot of our multifamily buildings have retail or commercial components to it, a parking garage, retail income, gym, things like that. So we need to be aware of that. What we're doing is we're moving that principal and or interest payments to the back of the loan, so we get repaid when the loan, we're never losing the money, we're just not getting it today. You get repaid when either the loan pays off or we refinance it when there's some event at that time. In regard to the second round, which we are now beginning, because a lot of our borrowers at April, May, and June, and we are seeing from a lot of our borrowers that the areas that are affected in residential seem to be the very high end, where everyone has fled to the Hamptons or New Jersey or Connecticut. We're seeing some of the areas being affected are the co-sharing spaces, and not what they always ask on the panels of like, it means like 4 people take 1 apartment. 4 24-year-olds move to New York City, they get a job at Citibank, and they go there for the entertainment, and there's no reason right now for these people to live in the city. They're not being required to go to work. There's no social interaction or dinners, bars. There's no cultural attractions. Add in a couple days of rioting, and suddenly living in Livingston, New Jersey doesn't sound so bad in mom's house, where you're getting cooked meals and you could do your work in your pajamas. So we're seeing weaknesses in those spaces. Overall,
Joe, are they vacating? Like, are they just vacating, or they're just living with their parents and not paying the rent in the short term? Like you expect, the owners expect them to come back.
Both. Right now, you're seeing one where they're either they're paying their rent, they're not living there. That's the best part. You're seeing that most of our strategic landlords timed the rental market so that these apartments come up in the June, July, August peak rental season. That is an issue because I've had landlords tell me, look, I offered these, kids or, whatever, these younger people,
Brats.
Whatever you want to call them, I work for a publicly traded company, July and August for free. And they're saying, we'd rather vacate and we'll deal with this in September, October, because they just don't know when their job is coming back, that they need to be in New York. And, a lot of people abandon the city anyway in the summer, so why stay to begin with? And then we're not seeing the new hires or the interns that we usually see, grab some of those spaces. We're on the rental collection.
You're referring to the Class A multifamily market, correct? These are Class A assets, so the higher end.
Depends also, not all of them. There could be, a 6-unit building where they're getting $4,000 for 3 people in Brooklyn. So it's not always. You're also on the higher end, like the $15,000-$10,000 a month apartments. People have left for the Hamptons or the Shore, and they're just, do I need this? The kids are being homeschooled anyway. Do I need to pay this? Or maybe I could just mess around with my landlord for a while. You can't get evicted in New York right now through August, so it kind of puts the landlords in a bind. We're seeing collections in the 80-90% range on most of the multifamily, but the problem is when you factor in the other income sources, the retail,
The commercial.
we have seen Papa John's not paying rent, Domino's not paying rent, Starbucks sending out letters. It's just not a good situation. I didn't know that Domino's was ever a sit-down in-person restaurant. I know Tony, when you go, you usually don't sit, right?
No, they usually deliver it. Thin crust.
Right. So
Sounds good.
what was I going to say? All right, you want to continue? Go on to Joe.
Or Tony. Modifications.
So it's interesting. It's interesting listening to you talk because you're obviously, as you pointed out in the beginning, you lend essentially in one market, right? And
Right.
you're looking at the factors associated with that market. So a couple of things I think that are different about what we're going through is, number one, we probably lend a little bit deeper into the capital stack than you do, and so we're there's a little, potentially less cushion in our deals that to defer interest and to increase our basis, and we're lending all over the country, and so that's what I said in the beginning. 90% of what we're doing is working through deals, and we don't have, similar to not having any programmatic lending today, we don't really have any programmatic workout today. We are, admittedly, we are picking and deferring and accruing, interest in a lot of situations. Most of the, I would say, now looking back on this, most of the workouts that we're doing have gone fairly smoothly, and most of the sponsors have. We haven't done a lot where we are only giving and not getting some commitment in return. And in most instances, the sponsors have stepped up. So we're trying to, stretch out, so help with liquidity, but not just grow our basis and the sponsor not stepping up a little bit. So that's what most of the workouts have looked like. There have been some what we believe are very opportunistic situations where everybody feels like, oh, hey, it's my turn. I watch TV. They said I don't have to do anything, so I'm coming to you to get you. So we've had some contentious workouts, mostly related to that, where the situations that they're trying to solve are not really related to this virus, but they're really just related to what existed before, and using it as an excuse and not really. Not coming to the table as a partner, but for the most part, we've had good, cordial, partnership type negotiations, and most importantly, though, I think it's because of the unknown of how this all plays out. It's mostly been 3 month to 6 month type negotiations, right? To try to at least put a plan in place for the next 90 to 180 days to get us to that point, and then see how things play out. And we're expecting a second round in almost everything that we've done. So,
yeah, I've heard your partner Warren say that you bank certain people based on their reputations and their experience on transitional deals. Like, you don't want to. This is not their fault. So as long as you feel comfortable, you've got the right borrower in a situation, I would think you'd want to keep this with this kind of uncertainty.
Yeah, exactly.
We're seeing a lot of opportunistic. It's amazing the delta on collections on new originations versus the forbearances. Somehow on new originations, it's much better but we've had people request who have interest reserves on vacant land loans that we don't have many of, that I need forbearance. I've had medical tenants, hospitals, so it's tough out there. And then there's some
borrowers that only seem to read the articles that say that you can't evict your tenants and no one's going to pay rent, and those are the ones that they seem to be forwarding to. They don't send you any of the positive news. It's a little odd.
Right.
So.
Got it.
Non-eviction is a big issue in New York because it really is strangling the landlords. The costs are already up on the rent stabilized. The taxes are up, and there's not much they can do. So.
Joe, you're talking about New York. Like, to me, I look at New York multifamily. Even before this COVID, right? We had a changed law. We have taxes going through the roof. We've got a political environment which, is very anti-landlord. And now we've got COVID. To me, it seems like a very bad place to be right now. Riots, closed retail. I think you should shave your head and move into the CMBS business with
Joe, if you want to talk afterwards, give me a call.
Very happy. At the end of the day, every one of you still wants to be in New York City, and it will come back. Occupancy, jobs. We just have to get past this vaccine. Hopefully, Tony, somebody who's working on that, and we can get past the vaccine. We'll be recovered very quickly. And you're seeing it. If the stock market is 90 days ahead of you, they always say, you were seeing it in the stock market now. So
yeah, my daughter is paying her rent. She's at NYU. She's home. We are paying our rent. We asked for extension from June to August. We got it, so we know what's going to happen next year. So
we'll mark your file.
I don't know about the owners if they're paying the debt, but we paid our rent.
How much is the rent, Sean?
Our share is $1,400. There are four. I don't know if that. I have four.
There's no doubt you negotiated some deal.
I did not actually, friend. Joe mentioned the recovery, which I want to just ask the question to the panel across the board. I watch the stock market. I sit here in my home office. I'm watching the stock market. I know nothing about stocks, but it seems like everyone is feeling really good. At one point, I don't know when it was, but a month ago, 45 days ago, the Dow Jones was something like 20,000, and I'm watching and I'm like, oh my goodness, this is bad. And now it looks like every day the market is improving. People feel good. You see riots, and you see people out in pools, lots of people around, much less cases of COVID. Like, what do you guys think, or what's the institutional view in terms of recovery, or, what do you think? It feels better. I'll say that, but.
Sure. Well, certainly if you're talking about the stock market, I think you can talk about the Fed and what they've done and how much that's impacted certainly Joe Dykman's business, the agency business. For the agency business and CMBS, when you're actively buying bonds in the secondary market, it instills a lot of confidence in buyers. And, today the bonds are trading tighter than where they were buying. So knowing that there's a backstop, you can kind of quantify your downside, and that's it's really important. Also, when you're sending stimulus checks to people, it's clearly going to have positive benefits on rent collections and moving the multifamily market. So I think the capital markets generally, the Fed's had a very, very big impact.
Yeah. Anyone else have any thoughts there? Yeah.
To add to that, I can't speak to the equities, but certainly I think in the CRE space, what we're seeing is a real bifurcation of credit, right? The assets that have performed well, there's still a market to get a loan, right? The assets, the retail deals, I think, and hospitality, those are going to be, very difficult to go and seek financing for. And there's no telling as to when that's going to get better. If, I know people are talking about the virus being less virulent and the number of cases are going down. And if we have a quick recovery, then hospitality will pop back a lot quicker. But until we know a timeline, I think you're going to continue to see a bifurcation in terms of credit available for assets that have performed and the assets that have not.
Tony, anything?
So me personally, I'm on the optimistic side of the spectrum in terms of I don't think that the world ended like some people do. That said, I also think there's a lot of unknown to this still. There's a lot of predictions as to like Joe Dykman just said, as to the hotel industry and where it's going to go and how it's going to get there. Slow, fast, up and down. I think that unlike financial crises in the past where you could throw some math at it, you can throw some math at this one, except it involves human behavior that is very much an unknown, right? Somebody said to me the other day that on like September 16th, and I'm not comparing the two situations, but it was a crisis. On September, pick a date, 18th, 2001, a lot of people were saying they weren't going to work above the 5th floor of an office building, right? And so, 3 months ago, a lot of people were saying we're going to be in our homes for a year. We're not going to go back to work for a year. And there's a lot of people that are pouring out into the streets right now the second they're allowed to. And not everywhere, right? I am down south. I'm in Florida. I obviously spent a lot of time in New York and a lot of my guys are in New York, and it's a much different. There's much different attitudes in different places in the country, and so it'll be interesting to see how this plays out. So I think my gut is that it won't be as negative as a lot of the negativity would suggest, a lot of the predictions would suggest, but there's going to be pockets that are going to be really, really tough to deal with. And I think, sorry for Joe and his 50-mile radius, but I think New York's going to be tough for a while. I think New York's going to be tough for a while. There's a lot of elevators that people don't want to get into in New York, right? So
yeah, but that's exactly the analogy you were making on September 18th.
Right.
By the way,
exactly.
Joe Fingerman.
I just flipped in my sense, but the point is, to me, I think that I'm optimistic, but I also don't think anybody really knows, which is why it's way harder than any time in our careers to have any kind of a prediction. I mean, I know people want to, and people read a lot of stuff, but whatever narrative you want, you can find somebody with a lot of really credentialed initials next to it to give you the data to support it. That's the way I look at it.
Like an appraiser, yeah.
Tony, I completely agree with you.
What's an appraiser? What's an appraiser?
I completely agree with you guys. I think that if people are saying they're not going to be in offices, they're not in New York City, people are going to be back. People have very short memories. This thing will go, and in a year or two, maybe shorter, I don't know.
If you're Joe Dykman and you're working from your 20,000 square foot house, I think you told me. I'm kidding, Joe. It's a joke.
We made that up.
25.
Hold on. What I'm
please
saying
don't get Joe in trouble.
I'm joking. What I think is funny is, I'm on a lot of conference calls. People are, I see like washing machines behind the people in their Zoom things. I'm sorry, but this can't last forever, and you can't train new people not being in an office, right? And I mean. Some of us have worked from home throughout our careers at different times and have a work from home and a work from office situation, but not everybody can do that, and we can't survive in a non-collaborative environment, and the Zoom thing 100%. Is not collaborative enough.
Listen, I've heard Mary Ann Ty at CBRE, the senior most person on the leasing side, say you're a 23-year-old, college student getting your first job. You don't come to New York to work out of your apartment. Right. And so you're going to want to be in an office. Companies that want talent are going to need to be in an environment, in an office. It's just not going to happen.
100%. Yes.
It's just a question. It really is a question of timing, right? It's how long is it going to take? That's all.
Right. It's really the recovery angle. Is it a swoosh? Is it a L? Is it a V?
I'm not going to name names, but there are also a lot of very, very significant leaders of companies that are saying they're going to let all their employees work from home, but they also sign a lot of leases, those leaders. And so, it doesn't hurt to get it out there that you might be looking for less space. Right?
And I could tell you, and I think we could all agree, managing a workforce that's not present every day,
right,
it's hard.
It is difficult.
But I think we'll still bet on the New York City multifamily than your hotel loans throughout the country. So, Or your recent construction loan. And Tony, I hear you're doing construction. So.
We have a hotel in on the west coast of Florida that had 72% occupancy, I think, during Memorial Weekend. We're fine.
How many rooms? 10 rooms?
6 rooms.
Tony, you're doing condo construction loans. You want to talk to us about all the flow you want of that?
That's not nice.
All right, I'm sorry. Never mind. All right, last question. Last question before we call it and we let everyone off the hook here. Given her all the turmoil here, right? Herb Brooks said great moments are made from great opportunities, and that's what we have here today. Where are your organizations finding those opportunities out of all this turmoil? I'll let anyone take it because you all got to think of something smart here. Uh-oh. All right, on that note.
No. Signature is looking at banks that are misaligned, business models that don't work, or, like we've hired some people from Wells, right? Because they've been having issues, they can't grow. So we've taken that in the West Coast team. We've brought in a bunch of teams on the West Coast to do banking out there. So we're just looking at other business models that might not be multifamily. Not that we're not dedicated to the business, but it doesn't need to be the growth engine it always has been. Is that an answer you wanted, or?
No, it's good. I don't want anything. I want you to make a lot more money. That's all.
Yeah, I'll jump in. I think for us, it's really the balance sheet side. I think for us, if you look at the pre-COVID to post-COVID pricing, balance sheet pricing is out anywhere between 100 to 175 basis points. for, a comparable type of credit, right? So you're lending less leverage, for a significantly higher price than you were a few months ago. So we're trying to make, smart lending decisions for core customers who need liquidity in this environment, and that's mutually beneficial for us.
Yeah, speaking for Newmark on the multifamily side, you'll see us, we've hired lots of sales brokers that are, best in class throughout the country. We're making a big push on both the sales and debt side. There's, we think, a lot of volume that can be done, certainly the second half of this year. So we're very focused on that.
How much you pay? I'm just kidding. Tony?
We're still recording, Sean.
We're gonna buy Signature. I'm just kidding.
Tony,
I'm
we'll
sure
finance.
Bring it on. Bring it
That was a
on.
joke, whoever's listening.
There are 3 people that left.
I would say
All of
that-
our analysts are enjoying it.
Exactly. I would say that one area I kind of alluded to before is that I think there's going to be an opportunity to provide some liquidity to some of the assets we have on our balance sheet today, and we look at that as an opportunity. And I think you're starting to see, as much as I'm optimistic, you're starting to see some distress in the market break free a little bit, and I think we'll play in that market as well.
Great.
What about you, Sean?
Listen, I've been spending a lot more time currently in the Fannie Freddie business because I think it is as hot as it's ever been. I think there'll be interesting DPO opportunities. We're starting to see situations where there's been a resetting of values in some of those big markets like New York on retail, which can't always be a zero. And so at some point, some of those will get reset, whether it's retail or otherwise. I think with CMBS out, suburban office, which everyone hates, could come back at some point and price at, decent rates and, or decent cap rates. So I think those are some of the things that I see and that I'm working on. So I would like to thank our panelists, our distinguished panelists. You guys were great. Really appreciate it. And we'd love to thank our sponsor, Steve Napolitano and Brother Jimmy, for hosting, and for everyone in the audience. We appreciate it. Everyone should stay safe and be healthy. And thanks for joining. Take care.
Thank you, Sean.
Thanks,
Thank you,
guys.
Sean.
Thanks.